Welcome to episode 3, and today we're going to be going over liquidity. So, liquidity is essentially going to be a magnet for price, okay? So, what it is, it's where resting orders are in the market, like stop losses, and it's where the market's going to pull to, so the big banks and institutions that actually move the market can get their orders filled and they can reverse price, okay? So, just it doesn't make much sense right now. I'm going to show an example of it. So right here, let's just say, okay, so let's say we're right here, okay, and we want to short the market. So we're going to open up a short position like right here. We're going to put stop losses above this high. So if price goes above there, we take the loss and we close the trade. Let's say we want to target, let's say this low right here, okay? And so we're going to go ahead and start playing it. Okay, and we get stopped out, okay? So now that we see a break of structure, and we see it go above this high, we're like, oh, okay, so let's go long instead. And blah, 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 whatever, stop loss is right here. And we get stopped out again. So essentially, liquidity is just the market, and it's areas where there's resting orders like sell stops and buy stops and stop losses. So we want people to get taken out of the market and for other people to go in the wrong direction, essentially. So those big banks and institutions can reverse and make their money, basically. So we're just going to go ahead and outline this, okay? So there's 4 ways the market moves, okay? This is from Justin Werlin, so if you want to go check him out. He's a great teacher for the concepts that I teach. And so this is from him. So there's 4 reasons why the market moves. It's rather hunting liquidity, which I just went over, or it's generating liquidity, which I will show you. Okay, so let's say market is moving up and down, up and down, up and down, up and down. It's generating a lot of liquidity, so there's a lot of people getting ready to sell below these lows, or a lot of people having stop losses below those lows. So you can take them all out and then pump like that. So it's generating liquidity. If it's consolidating, like moving sideways, rebalancing inefficiencies, which is like a fair value gap, which I'm going over in the next video, and rebalancing to equilibrium, which I'll go over in a few videos over. So there's 2 types of liquidity: external liquidity and internal liquidity. So external liquidity is just going to be like prominent highs or lows, okay? So we have this big low right here, okay? Look at this candle, okay? This is going to be a spot of high liquidity. So let me find an example for you real quick. Okay, so let's go down to the 1 hour. All right. And so let me find a good one. Okay, so this one right here. Okay, so say market's moving, okay? We have this low right here. This is external liquidity, okay? So price takes it out, takes out the low. So it takes people out of the market and brings sellers into the market. And then it reverses. So it's basically, in a nutshell, it acts as fuel for the market to move where it wants to. And so it takes out that low, takes out the liquidity, and then pumps, okay? So that's an example of external liquidity. And we can see also a good example right here. Here we go. Let's go down to the 30-minute. Okay. So this is like, okay, so these are equal highs, okay? This high is just about equal to this one. Let me move this back a little bit more and replay it. Okay. So right here we have this equal highs right here. This high, equal highs, right? And this is actually also a stronger point than just a single drawn liquidity, just a single high or low. And so if we play it, it takes out that high and then dumps down, okay? So axis fuel is where the market wants to go, up or down. If it wants to go up, you're going to usually see it take out lows. If it wants to go down, you're generally going to see it take out highs, okay? So that's external liquidity, just highs or lows. And through experience and a couple of examples that I will go over later in the series, I will show which swing lows and which swing highs you want to be looking at. And so actually I will go over this. So a big drawn liquidity is session highs or lows. Okay, so let me remove this. Okay, so let me see here if I can find an example real quick. Let's see, let me find a good example. Okay, so here we go. This is actually a trade I took. So we can see London session. Look at the bottom blue. London session. So let's go ahead. This is the range of London session, okay? This is the high at this spot, and this is the low. And so I basically, that day I wanted to see market go down, so I wanted to see a high to get taken out. And this is the high of London session right here, okay? So you can see once New York opens, it aims to take out the high and then goes straight down and takes out this low of the last day's New York session, okay? Let me see if it wants to go down. Okay. And it takes out that low, and then once it takes out that low, it goes up and takes out the high again. So that's that for external liquidity. And so like I said, there's certain points that you're gonna see of high probability of just high points of concentration for liquidity, and session highs and lows are very good to look at if you're not fully understanding the concept. And then so like I said, we have external liquidity. Okay, so it's going to be like an inefficiency, which I will go over in the next video. And just in a nutshell, it's a fair value gap. So it's going to be a gap in the market, and it's internal liquidity. It's going to be like gaps or like imbalances. So this is what you're going to be seeing, just a big gap, and I will explain that in the next video, just so I can separate these videos, make it more simple, and allow you to pull everything in and not go too fast, but not go too slow. So with that said, I'm going to be moving on to the next thing in the next video.